Welcome everyone, this is Lemoncello from Toronto. Today I thought I'd change the format a little bit. I thought I'd share with you some news or an article. This is a little bit dear and near to my heart, meaning a part of the topics that I like to research for myself that I'm interested in, and I thought you might be interested in this as well. This is an article from Forbes. It's titled "Central Banks Are Getting It Wrong About the Next Recession." So as you can imagine, it's pertaining to the recession or the most that's starting to become a popular voice. So it begins. It says central banks overwhelmingly focus on targeting inflation, yet more attention to the inflation cycle by central banks could go a long way to extending the business cycle. As a case in point, the U.S. Federal Reserve Bank, the Fed, its chief, Jerome Powell, surprised markets with his ultra-dovish stance for the second time in as many meetings. Powell expects no more rate increases this year and will end the balance sheet wind down by September. He stressed that inflation was tame and modestly downgraded growth expectations. Equity markets jumped in this response to the news, while Treasury yields dropped as investors assume an end to Fed tightening and rate cuts in 2019. Now, this view is driving the current Treasury yield curve inversion. So as you heard, we have an inversion. It has been going on for the last little while. The three-month Treasury rate exceeds the 10-year rate. Normally, this is quite reliable in terms of signifying that in the near future we're going into recession territory. Now, it hasn't been having the normal effect it normally does. Powell says that while inflation remains subdued, growth still looks solid and unemployment is low. So he feels confident that the market is doing great, while the inverted yield gives us a different picture. The article goes on to say that the way what the Feds are relying on is outdated. Basically, the methods and strategies and the tools that we use to pick up on market indicators are outdated because we're focusing on the wrong areas. Focusing on inflation, it says, is kind of the wrong way of doing things. This is based on the Bank of International Settlements, a little bit of research that they have done with respect to this. So BIS, the Global Central Bank Coordinator, has presented compelling research that this blind allegiance may be outdated. So this is a research relying on 140 years of data across 38 countries. The BIS found weak links between growth and inflation. Instead, what they found was changes in equity and house prices were better predictors of growth. So focusing on equity, meaning net worth, loans, and house prices are better indicators of how our economy is doing. So since the 1980s, it lets us know that we've been through 4 recessions and that only one was caused by the Fed when they increased the interest rate in 1980. The other 3 recessions were all caused on other factors, not on the Fed and the interest rate. Therefore, the article continues, we should re-examine the way we judge when we are or we're not in a recession territory or when it's coming. Now, it does tell you in a brief phrase that the three following recessions were either ignited or amplified by asset bubble disruptions, basically in the area that we're in today, meaning there's a bubble in the stock market, a bubble in the equities market, a bubble in the bonds market, etc. I think it's a good article to read. It's easy. It gives you a lot of background. It helps expand on the concepts. Let me know if this is something you're interested in and you enjoy. Hope you have a wonderful day.